Hey everyone, and welcome back to Talk Tickers. Today, we are diving into Unum Group's Q4 2024 earnings call. They are, a big player in the employee benefit space.
Huge.
Yeah, we're talking 47 million customers. And they just had a really good year. I mean, their stock price is up over 20% in the last quarter alone.
It's been quite a ride for sure, yeah. And from what we heard on the call, it doesn't sound like that momentum is slowing down anytime soon.
So let's break it down for our listeners. Unum absolutely crushed their earnings expectations for the full year. We are talking 10% EPS growth here. And it's not just like a one-time thing, right? Their core operations are super healthy, delivering a return on equity of over 20%.
That's fantastic. Really shows how strong their underlying business is. They're doing a lot of things right.
And speaking of capital, they're practically swimming in it. $2 billion in cash at the holding company, plus a 430% risk-based capital ratio. I mean, that's
a lot.
That's a lot of financial breathing room. Can you just break that down for me? What does that really mean?
Well, think of it as like a fortress built around their finances. That high RBC ratio. It means they have this huge cushion to absorb any potential losses that might come up. And it also gives them a lot of flexibility for future investments, strategic moves, They're playing with house money now.
Okay, so they're financially solid, crushing earnings. The LTC situation seems to be under control. So what are they doing with all this cash?
Well, they're definitely not just hoarding it. They announced a 15% dividend increase, great news for shareholders. And they've been aggressively buying back their own stock to the tune of $1 billion.
Wow, sounds like they're pretty confident about their future. So what's the outlook for 2025?
They're projecting more growth. Think high single-digit sales growth across the board, which would be a major win in this economic environment.
And what about premium growth?
They are forecasting a solid 4% to 7% range. Plus, they seem committed to maintaining strong margins. Through their disciplined underwriting process, they're aiming for EPS growth between 8% and 12%, which would be quite impressive.
So they're not just going for like breakneck growth. They're aiming for sustainable, profitable growth, which is...
It's a delicate balance.
Yeah, tough to strike.
For sure. And here's where things get really interesting. They're making big bets on innovation. Their customer-centric approach is driving the development of new solutions, like HR Connect, TotalLeave, GAF, Help at Hand. These are all designed to simplify the whole benefits experience for both employers and employees.
I'm curious about these initiatives. Can you give me like a concrete example? How are these solutions making a difference?
So take their TotalLeave program, for instance. It tackles a huge pain point for companies. Managing employee leave. It streamlines the entire process, makes it easier for employers to track leave, ensure compliance, and provide employees with a smooth experience when they need time off.
So they're positioning themselves as the experts in leave management. I mean, that's smart. It's a need a lot of companies have. But are they just focusing on that?
Not at all. They're also seeing this growing trend, companies wanting a one-stop shop for all their employee benefit needs. So Unum is making it easier to enroll, bill for, and administer all these different benefits seamlessly.
Yeah, companies are busy enough, so anything that streamlines HR functions, it's going to be attractive.
Yeah.
I wonder about their international operations. What's happening there?
Well, they're making waves in the UK. They launched this brand new claims portal for large customers. It's the first of its kind, very innovative, and it seems to be getting a lot of attention.
Okay, back to the elephant in the room. Long-term care, we know they didn't have to use any capital for it in 2024. But what about the long game?
Well, they're more than halfway through implementing this premium rate increase program, which is a positive sign. It means they're actively addressing the financial stability of their LTC business.
And remember that huge capital cushion we talked about.
Okay.
Well, they specifically have a $2.6 billion buffer built into their LTC block. Talk about prudent risk management.
Yeah, it's clear they're being cautious and strategic about LTC. They're still exploring risk transfer opportunities, potentially offloading some of that risk. But their main priorities are clear: grow the core business and deliver value back to shareholders.
Which brings us to a critical question. With all this financial strength and cash flow, what are they going to do with it all? I mean, they've laid out their priorities. But how aggressively will they pursue acquisitions?
That's the million-dollar question. And will they ramp up their share buyback program even further? Lots of options on the table. It makes them a very intriguing company to watch.
All right, ready for some speculation.
Yeah.
This is not financial advice, but let's have some fun. What if Unum decides to make a splash in the employee wellness space?
Okay, I'm listening.
What if they acquire a company like Headspace or Calm, those mindfulness and meditation apps, And then they could integrate those resources into their benefits packages. Imagine mental health support right alongside health insurance and disability coverage.
That's a bold move. But it's not as crazy as it sounds. Companies are increasingly recognizing the importance of employee well-being, and offering those resources could be a game changer for Unum.
Could attract new clients who prioritize employee well-being. Give them a competitive edge. It would definitely be a signal that they're thinking outside the box.
Yeah.
And innovating beyond traditional benefits.
It's a provocative idea. We'll have to wait and see what they decide to do with all that firepower. But it's clear they're in a strong position to make some significant moves in the market.
So we've talked about their overall performance, their strategic direction.
Huh?
Now let's look at the specifics of their different segments, starting with their U.S. operations.
Let's dive in. All right, so their U.S. operations had a pretty impressive year. Their adjusted operating income for the full year hit $1.4 billion, a solid 6.2% increase compared to 2023.
And a big part of that success is coming from their group disability line. Those margins remain strong, which is great news considering that's one of their core products.
Yeah, their group disability is really killing it.
And their group life and AD&D product line also saw a massive jump in earnings, like a whopping 62.8% increase for the full year.
Those numbers are incredible. Really shows the strength and profitability of their core offerings.
Now, I know some listeners might be wondering about those supplemental and voluntary lines, particularly voluntary benefits. There was some pressure on those in the fourth quarter, right?
Yeah, there was. But it sounds like more of a temporary blip than a sign of trouble. They're actually expecting earnings in those areas to bounce back to more normal levels in 2025.
Okay, so not a major cause for concern. Looking at growth, their U.S. earned premium climbed 4.6% to reach $6.9 billion. That's a mix of natural growth, strong sales, and good persistency, meaning they're holding on to their existing customers.
It really shows they can attract new clients and keep the ones they have happy, which is a great sign for long-term stability and growth.
Now let's see what's happening with Unum International. That segment continues to impress, both in terms of earnings and top-line growth.
Absolutely. Their full-year adjusted operating income came in at $157.8 million. While that's relatively flat compared to the prior year, there's more to the story.
There's always more to the story. What's the catch?
Well, remember how the UK experienced that high inflation in 2023? That actually boosted Unum's results that year. So when you adjust for that inflation factor, their UK earnings actually jumped by about 15% compared to 2023.
So the underlying strength of their international business is even more impressive than it appears at first glance. Very interesting. What about their fourth quarter results in the UK?
Right in line with expectations, falling within that mid to upper £20 million range. They seem to have a good handle on that market, delivering consistent results.
And looking ahead to 2025, what are they projecting for the UK?
More of the same. They're anticipating continued growth in that range, figures in that upper £20 million range. That kind of consistency is great for investors. Suggests Unum International is on a solid growth trajectory.
And their UK premium growth surged by 9.4% for the full year, fueled by strong sales growth of 6.6%. That's impressive, especially in a mature market like the UK.
Yeah, it really shows how effective their growth strategies are. They're not just resting on their laurels, actively finding ways to expand their market share.
And it's not just the UK that's shining. Their Polish operations also delivered impressive growth. Premiums soaring 24.2% and sales increasing by 4.2%.
It's like their international operations are firing on all cylinders. They're finding success across multiple markets, diversifying their revenue streams, making them less reliant on any one region. Always a good thing.
Okay, let's talk about Colonial Life, another important piece of the Unum puzzle.
Let's do it.
So their sales were down for the full year, but their premium growth remained steady at 3.3%.
So even though they face some headwinds, they still managed to expand their premium base, which is a testament to their resilience and their ability to adapt to changing market conditions.
And here's the even more impressive part. Their margins stayed exceptional. Their fourth quarter adjusted operating earnings hit a record high, reaching $122.7 million.
That's incredible. Talk about efficiency and profitability.
And for the full year, their adjusted operating income came in at $466.7 million, a 16.6% jump compared to 2023. That translates to a stellar 19.7% return on equity, up from 18.1% the previous year.
Those are outstanding results. Colonial Life is clearly a very valuable contributor to Unum's overall success.
Anything else that stood out to you from the Colonial Life results?
I was really impressed by their focus on technology and innovation. They've rolled out some innovative tools, like their Agent Assist platform, which is designed to help agents be more efficient and productive. It's a smart move, especially in today's digital world.
Yeah, investing in technology can be a game changer, not just for efficiency, but for attracting new talent, enhancing the customer experience.
Exactly. It shows they're thinking long-term, investing in the future of their business.
All right, let's move on to their corporate segment. This primarily consists of corporate debt-related expenses, and it reported a loss of $50.4 million for the quarter.
Yeah, that's not unexpected. Corporate segments often reflect those costs of running the overall business. Things like administrative expenses and interest payments on debt.
It sounds like they're expecting that level of loss to continue into 2025. Now on to the much-discussed closed block of business. Their fourth quarter adjusted operating earnings were $27.7 million.
That brings their full-year earnings for that segment to $137.8 million, right on target with their projections.
Yeah, they had forecasted earnings between $130 million and $160 million for the closed block. So they hit the mark.
It seems like they have a pretty good grasp of how that block is performing. No surprises there, which is always good for investors.
Let's dig a little deeper into the closed block. Their LTC net premium ratio, which gives us a glimpse into their expected lifetime benefit ratio, edged up slightly to 94.6% from 94.5% in the third quarter.
Yeah, what's notable here is that LTC incidence rates, the rate at which people are making claims, remained higher than their long-term projections. This is a similar pattern to what we saw in the third quarter.
So more people are filing claims than they had initially anticipated.
Yeah.
What's driving that trend?
Well, they believe it's mainly due to a normalization of inventory levels. After the pandemic, during the pandemic, a lot of routine medical care and claim filings were delayed.
Right, so there's a catch-up effect happening now.
Exactly, and they acknowledge that there might be some continued volatility in incidence rates going forward. It's a dynamic situation they're closely monitoring.
Now let's talk about their alternative investment portfolio. This is primarily tied to their LTC business, and it generated $30.5 million in income for the quarter.
That translates to an annualized yield of 9.1%. Which is a really good return. It shows how effective their investment strategy is. And since its inception, this diversified portfolio has delivered returns in line with their long-term expectations of 8% to 10%.
That consistency in their investment performance is definitely reassuring. It shows they're not just taking on excessive risk to chase returns, they're being prudent, generating solid returns over time.
It's all about balance and sustainability. Now, stepping back from the quarterly numbers for a moment, let's take a broader look at the overall health of their LTC block.
Yeah, that's a critical piece of the puzzle for investors to understand. What's the big picture look like?
Overall, 2024 brought some positive trends for their LTC business, including the sustained higher interest rate environment and their ongoing progress in securing those premium rate increases. Both are favorable developments for them.
So they're getting some tailwinds from the macroeconomic environment and their own strategic initiatives.
Absolutely. And these factors have had a significant impact. By the end of 2024, they had achieved over 50% of their targeted premium rate increases outlined in their current program.
That's excellent progress. Shows they're taking proactive steps to address the need for rate adjustments, make sure that business remains financially sound. And how are regulators responding to these rate increases?
It sounds like they've been quite receptive. Unum has been clear about the need for these adjustments. They've been working collaboratively with regulators throughout the process.
That's great to hear. So rate increases are progressing smoothly. And what about the impact of higher interest rates? How's that playing out for them?
Well, as you know, higher interest rates are generally beneficial for insurance companies, especially for those with long-term liabilities like LTC. And Unum is no exception. They've been actively managing their hedging program to take advantage of this environment.
Hedging can be a complicated concept. For people who aren't familiar with financial jargon, can you explain what that means?
Sure. Think of hedging as a way to protect yourself against potential losses. In this case, Unum is using hedging to protect themselves against the risk of interest rates falling. Their hedging program remained active throughout the year, with $2.6 billion in outstanding notional at year-end, and an average hedge rate of 4.3%.
So they've got a substantial amount of their investments hedged, which helps to reduce their exposure to interest rate risk. And that hedge rate, 4.3%. What does that tell us?
Well, it's important to note that it exceeded their best estimate ultimate assumption for the 30-year Treasury, which stood at 4.25%. This means their hedging strategy is proving effective in mitigating potential losses from interest rate movements.
So they're not just hedging, they're hedging effectively. That's a big win for them. Anything else noteworthy about their hedging strategy?
Earlier in the year, they seized the opportunity to extend the time horizon for their hedged investable cash flows, stretching it from 5 years to as long as 10 years in some cases.
So they're taking a long-term view, locking in these favorable hedge rates for an extended period. It's a smart move, especially considering the uncertainty in the interest rate environment.
They're definitely being proactive and strategic about managing this risk, and they seem very satisfied with the results of their hedging program and the protection it's providing.
And remember, all of this reinforces their conviction that they won't need to put more capital into the LTC business. They made that very clear during the call.
Yeah, it's a bold statement, shows how confident they are. In the current financial position of their LTC block, their capital deployment decisions in 2024 reflected this confidence, allowing them to focus their resources on expanding their core operations and returning value to shareholders.
That's a significant shift in focus. It signals that they believe their LTC business is stable enough, that they can prioritize growth and shareholder returns.
Absolutely. And their confidence is further bolstered by that $2.6 billion protection buffer built into their LTC block. It's a substantial cushion, provides a significant margin of safety.
It sounds like they've done their homework, analyzed the risks, taken the necessary steps to ensure the stability of their LTC block.
Yeah.
And with that stability in place, they're free to pursue other opportunities.
Exactly. They're in a strong position to capitalize on growth and create value for shareholders.
So they're feeling good about where LTC stands.
Yeah.
But they're not just sitting back and relaxing. They're still actively managing that business and exploring different options.
Right. They're taking this two-pronged approach. Internally, they're focused on risk management strategies, like their hedging program, and potentially pursuing further premium rate increases.
Those are sensible moves,
Yeah.
especially considering the uncertainties of the LTC business. But what about external options? What are they considering there?
Well, they're continuing to explore opportunities for economic risk transfer. Basically, this means finding ways to transfer some or all of the risk associated with their LTC block to another party.
So they're looking for a partner. Who's willing to share the burden, so to speak?
Exactly. And it sounds like they're being very strategic about this. They want to make sure any transaction benefits both Unum and its shareholders.
Makes sense. They're not just going to jump at the first offer. They're being patient and selective, which is a good sign.
And they've been transparent about providing investors with updates on their LTC block. They included key metrics and demographic information in their presentation materials.
That level of transparency is always appreciated. Gives investors a clearer picture of what's happening with that business. Helps them make more informed decisions.
It's a complex business, and Unum is doing a good job of keeping everyone in the loop.
Right, so we've covered a lot of ground. We've talked about their strong earnings, their robust capital position, their strategic initiatives, their plans for managing the LTC block. It's been a pretty comprehensive overview.
We've left no stone unturned.
Now it's time to shift gears. Look ahead to 2025. What's their outlook for the year? What kind of growth and earnings power are they anticipating? And how does that translate into capital generation?
Okay, let's dive into those projections.
The main theme of their 2025 outlook is consistency. They expect the positive trends that drove their strong performance in 2024 to carry over into the new year.
Yeah, that's a reassuring message for investors. It suggests their success isn't a fluke. It's a reflection of their solid fundamentals and their ability to execute their strategies.
Specifically, they're anticipating continued strong margins in their group disability and life product lines. Those are key drivers of their profitability. So their continued strength is a positive sign.
It shows they're not just winning business, they're winning profitable business. That's what drives sustainable long-term growth.
And those sustainable margins, combined with their projected top-line growth and their share buyback strategy, give them confidence in achieving earnings per share growth in the range of 8% to 12% in 2025.
That's a healthy growth target, especially considering they achieved 10% adjusted EPS growth in 2024. Shows they're not just resting on their laurels, they're constantly striving to improve.
Now let's unpack their expectations for top-line growth and returns. In their core businesses, what are they projecting in terms of sales and premium growth?
Well, they're building on the momentum from 2024, when they achieved 4.3% core operations sales growth. They're expecting sales to accelerate further in 2025, projecting continued success in their Unum U.S. and international segments.
And what about Colonial Life? Remember, their sales were a bit soft in 2024. Are they expecting a rebound?
Absolutely. They're projecting Colonial Life to bounce back, With a growth range of 5% to 10%, they're seeing a lot of positive signs, like the success of their Gather platform and the strong adoption of their Agent Assist tool.
So they're feeling good about Colonial Life's prospects for 2025. And across all their segments, what kind of premium growth are they expecting?
They're projecting different growth trajectories across their various product lines, but importantly, they believe their core operations will continue to generate results in line with their long-term expectations of 4% to 7% premium growth.
That's a pretty healthy range. Shows they're confident in their ability to continue attracting new customers, expanding their business.
It's also worth noting that they're achieving this growth while maintaining those strong margins. They're not just chasing top-line growth at the expense of profitability, striking a good balance.
That's a key point for investors to understand. Sustainable growth is about finding that sweet spot between top-line expansion and bottom-line profitability.
Exactly. And they're demonstrating that they can expand their global footprint without sacrificing their financial discipline.
And that's reflected in their return on equity. They're generating robust returns across all their segments, outperforming many of their peers in the industry.
It's a testament to their effective management, their strong brand, and their ability to execute their strategies.
All right, let's shift gears from GAAP metrics and focus on their capital expectations for 2025. We know they're generating a lot of cash. What are they projecting in terms of capital generation for the year?
Well, they're expecting continued strength in their capital generation model, building on the excellent results they achieved in 2024.
Remember, they ended the year with $2 billion in cash at the holding company and a 430% risk-based capital ratio. That's a lot of financial firepower.
And they're expecting to generate even more capital in 2025. They're projecting total capital generation in the range of $1.5 billion to $1.8 billion, up from their previous outlook of $1.4 billion to $1.6 billion.
That's a significant increase. Underscores the strength of their cash flow generation. Where's all that cash coming from?
Their primary source of cash generation is earnings from their U.S. insurance subsidiaries, which are distributed as dividends to their holding company.
So the core business is doing the heavy lifting.
Yeah.
Generating the cash, fuels their growth and shareholder returns.
Exactly. And they also receive dividends from their UK operations and generate income from fees charged to their operating companies, notably asset management fees.
Those diverse sources of income contribute to the stability and predictability of their cash flows. Always good to have multiple streams of revenue.
Now, the big question is, what are they going to do with all that cash? How are they planning to allocate that capital in 2025?
Well, it sounds like they're sticking to their priorities. They're not planning any major changes in their capital allocation strategy.
Yeah, they're going to maintain their disciplined approach, balancing investments and growth with returns to shareholders.
Specifically, they're going to continue servicing their debt, steadily increase their dividends, and return capital through a substantial share repurchase program.
It's a balanced approach designed to maximize shareholder value. They're not just focusing on one area, spreading the wealth, so to speak.
And speaking of share repurchases, how much are they planning to buy back in 2025?
They're anticipating repurchasing between $500 million and $1 billion worth of shares. But they're going to continue evaluating their capital deployment priorities throughout the year.
So they're keeping their options open. So that flexibility is important, especially in a dynamic market environment. Allows them to adjust their plans as needed, take advantage of opportunities as they arise.
And to put that buyback range in context, remember, they repurchased approximately $700 million worth of shares in 2024, excluding those repurchased as part of their PCAPS transaction in the fourth quarter.
So their projected buyback range for 2025 represents a continuation of their commitment to returning capital to shareholders. They're clearly focused on creating value for their investors.
Now let's look at their capital level expectations. For the end of 2025, they provided some key metrics on page 12 of their presentation.
Okay, what are the key takeaways? What kind of capital levels are they projecting?
They're anticipating maintaining strong capital levels, comfortably exceeding their target levels, which are set to preserve their current credit ratings.
So they're not just meeting their targets, they're exceeding them. That's a good sign. Shows they're being prudent, maintaining a strong financial cushion.
Specifically, they're projecting their risk-based capital in their traditional subsidiaries to fall between 425% and 450%. Their holding company liquidity to surpass $2 billion, and their leverage capacity to range between 21% and 22%.
Those are all very healthy metrics. Paints a picture of a company. That's excellent financial health.
And as they've consistently emphasized, they're going to continue managing their capital prudently. They're not planning any sudden or dramatic changes to their capital structure.
So steady as she goes, they're sticking to their disciplined approach, which has served them well so far.
While they do intend to manage those metrics down over time, to move closer to their target levels, their near-term priority is to maintain this robust capital position, which affords them tremendous flexibility.
That flexibility is a key asset. It allows them to pursue a wider range of strategic options, react quickly to changes in the market.
Enables them to further advance their business strategy and potentially return even more capital to shareholders if the opportunity arises.
So they're in a strong position to capitalize on opportunities as they arise. It sounds like they're firing on all cylinders.
They really are. They had a fantastic year in 2024, and they're well positioned for continued success in 2025.
They're executing their strategies, delivering for their customers, creating value for their shareholders. What more could you ask for?
It's a compelling story.
Now, before we wrap up, I want to remind everyone that this is just our analysis of Unum Group's earnings call. It's not financial advice.
That's right. We're just sharing our thoughts and insights based on the information we've gathered. Always do your own research. Consult with a qualified financial advisor before making any investment decisions.
Investing always involves risks. It's important to carefully consider your own individual circumstances and goals.
Exactly. Don't just blindly follow our opinions. Do your own due diligence. Make informed decisions that are right for you.
All right, that concludes our deep dive into Unum Group's Q4 2024 earnings call. We hope you found it informative and insightful.
We had a great time breaking down these results, and we hope you learned a thing or two about Unum Group.
Thanks for tuning in to Talk Tickers. Until next time, happy investing.
See you next time.